Q4 of last year, I'll write that here, Q4 of last year, draining. Q1 of this year, it's been going down, which means liquidity has been rushing back in. Now, we can see this in asset prices if we look at Bitcoin, for example, right here. Same time period. So we can see when the dollar index went down, liquidity went up, Bitcoin went down. It dropped down. We can see here that last quarter, as the dollar index got stronger, liquidity went down, Bitcoin dropped with it. And now, we can't really see it here, but now Bitcoin has made a big turnaround. I think it's up 10, 12% in just like the last 2 days at the time of this recording. And you can see the same thing in NASDAQ. Over the same time period, you see the same movement as the dollar and the global liquidity moves up and down, the prices come up, it drops down, and now we're starting to revert because that first quarter liquidity is just starting to come into the system.
The financial markets have been on a wild ride, and the secret behind their twists and turns lies in one powerful force: liquidity. Late last year, as the US dollar flexed its strength in Q4, capital began draining from the system, leaving risk assets like Bitcoin and tech stocks gasping for air. But now, the tide is shifting. The dollar's recent retreat has unleashed a wave of liquidity back into the market, and the rebound has been explosive. Bitcoin, after months of pressure, has rocketed 10 to 12% in just days, while the Nasdaq mirrors the same exhilarating surge. This isn't random. It's the unmistakable rhythm of liquidity at work. Financial analyst Mark Moss puts it plainly. Q4's liquidity drain bled into Q1, but now the pendulum is swinging the other way. When the dollar weakens, liquidity floods back in, and asset prices ignite. The evidence is everywhere: Bitcoin's sudden rally, the Nasdaq's synchronized bounce, all tracing back to the ebb and flow of global capital. And with liquidity just beginning to re-enter the system, this could be the spark that reignites the bull market. For investors watching the dollar's next move, one thing is clear: the rebound is here, and it's picking up speed. We will now bring you more clips from Mark Moss's explosive analysis to gain more insight. Please don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Let's just start here. The first 100 days of Trump's term. Here we are in the first 100 days, and it has been turbulent, to say the least, right? Lots of noise. Maybe he's an idiot. Maybe he doesn't know what he's doing. Maybe, we don't know. But what we do know is that we've seen 10 days and $10 trillion market swings. So we've been seeing massive volatility as things go up and down, as Trump is basically trying to reorganize the entire global monetary system. Not a small feat. Now, we can see that in that time, I put this green mark here, we can see that the markets came all the way down, came back up, went down, went back up, and currently right now, they're down about 10%. This is the S&P 500. Down about 10%. Now, with all of this happening, and he's an idiot, and he's wrecking the economy and all these things, we're down 10%. Now, just for a little bit of historical perspective, here we were down 10% here we were down 6% here we were down 10% here we were down 10% here. You see, 10% isn't all that uncommon. So we're seeing that, but yes, it has been volatile, it's been back and forth. But here's the thing. While that has been wiped out, there's an undercurrent that really shows us what's really going on. And this is what you need to know if you want to navigate these markets. Liquidity is what drives asset prices. So we want to keep our eyes on liquidity. So let me show you what I'm talking about. In 2024, last year, before Trump took office, in the last quarter 4 of 2024, we saw declining liquidity. Liquidity was draining out of the system, and that pushed asset prices down. Now, for the first quarter of 2025, quarter one, we've seen rising liquidity. What we can see here is here's 2024. And what we can see here in September of 2024, we had a high of global liquidity at $175 trillion. 175 trillion. And what we can see is through the end of 2024, we went from 175, 173, 172, 171. Liquidity was draining out of the system. So liquidity is draining down. Then here we have 2025. And we started January with 171, obviously carrying over. 171, 171, 172, 172, 172, 172, 173, 174, 174, 176. Liquidity's been going up. Now you're saying, but Mark, I don't understand this because you're saying liquidity went down last year, but the price has been going down this year, but you're saying prices are going down when liquidity is going up. I don't understand what's going on. Well, let me break it down for you. So we have $176 trillion of global liquidity as of last week per Michael Howell. That is a positive gain of $5 trillion, hence the title of the video, $5 trillion tsunami. $5 trillion year to date has been added. That's how much it's gone up. The reason why you're not understanding the linkage is because there's about a 10 to 12 week lag in between that. So liquidity draining out in Q4 of last year, we saw the impacts of it in Q1 of 2025, mostly towards the end because of the lag. All the liquidity we've seen rush in this year, this first quarter, will be seen next quarter. And we're already starting to see that. And here we have global liquidity mapped out from June of 2021. We'll just put 21 right here. Now, I started using this chart right around here. If you've been watching my channel for any amount of time, you know that when the whole world was going to end and everyone needs to get out of the markets back in 2022, because it was the low right here, I started making videos. Go check out my channel. I said, there is no market crash coming. Here's why. It's time to start buying. Here's why I'm buying new assets. And it's because I understood this. And since then, the markets have been on an absolute tear because that was the bottom of liquidity. Now, these things typically move in a 4-year cycle. So we've had about 4 good years of runs. Nothing goes up and down in a straight line, obviously. We've had 4 good straight years of runs. Now, let me zoom in a little bit and look a little bit closer. I want you to see this. So here's what we have now over the last year. So what we had is last year, 2024, the last quarter, liquidity was draining down. In the first quarter of this year, it's going up. We're going to zoom in a little bit so we can see this. And this is what we're talking about, the $5 trillion that we'll see next quarter. But let's just take a look at this and see how else we can see this data. So here is the Dixie, the dollar index, and it measures the dollar against other currencies. Now this goes back until 2019. And what we can see is that the dollar got stronger into 2020, then it got weaker, then it got really strong into 2022, which is when liquidity drained out and asset prices crashed. And then as the dollar got weaker, liquidity went up, asset prices went up, we chopped back and forth. Now we have to understand these metrics and how this works on a lag so we can really start to position ourselves, because what we're seeing right now is a lot of people are fearful. A lot of people are exited out of the system. A lot of people are waiting for the next leg to drop. They think the world is coming to an end, like as if the world is more uncertain than it was in the pandemic of 2020 when the whole world was going to die and shipping lanes and businesses were shut down, or it's more uncertain than it was in 2008 when the great financial crash, the global financial system melted down.
Markets are roaring back, but most investors missed the signal. Trump's turbulent first 100 days saw wild swings, yet the real story is the $5 trillion liquidity surge quietly fueling Bitcoin's 12% bounce and the Nasdaq's rebound. Liquidity moves first, prices follow. When capital drained last fall, the pain hit this spring. Now, the tide has turned. The dollar's dip is the spark. The lagged rally is next. Smart money isn't watching headlines, it's riding the wave. Don't chase noise. Follow the flow. Gold and Bitcoin are screaming higher. Here's the explosive truth. These scarce assets are ultra-sensitive to liquidity waves, and right now, a $5 trillion tsunami is flooding markets. What happened? After Q4's liquidity drain crushed prices, the reversal began. With a 10 to 12-week lag, gold's breakout and Bitcoin's $10,000 surge are just the start. While politicians play trade war chess, smart investors track the real game changer, global liquidity. The tidal wave is here. Will you ride it or miss the boat? Let's watch more clips from the interview.
If you want to know why gold is taking off so rapidly right now, it's because gold and Bitcoin, hard assets with limited supplies, scarce supplies, are more sensitive to liquidity. So what we can see is that gold on a 10 to 12 week lag moves about the same because it's more sensitive, and it also rises and falls with liquidity. So here we have a chart, again, from Michael Howell, global liquidity in orange right here, and the gold price in black. And so we can see these moves and the lag that we have in them. And so we're seeing right now with the global liquidity ticking up and the price of gold is going up, and eventually these lines will catch up. We can see the same thing if we look at it in Bitcoin terms as well. So for example, Bitcoin is similar, except for it's a fixed supply, not a scarce supply, right? There will never be more than 21 million, which makes it much more sensitive. Not to mention, not just because of the scarcity, but also because of the size of the market cap. It's much harder to move a $14 trillion market cap than it is a $2 trillion market cap. So we can see that Bitcoin is very similar, except for in this case, it's also much more sensitive because of the liquidity and the overall size. And again, we have the global liquidity in the orange line right here. And we can see how we're ticking up right here, but the Bitcoin price hasn't responded yet. Why? Oh yeah, because there's a 3-month lag. So this right here in January, we'll start to see right here in April. And we already have. We've already gone from about 80 to over 90,000 in just 2 days. So we're starting to see this moving in really, really rapidly. Now we can see this. Here's another chart from Raoul Pal, and he shows this in a similar way, but he adjusts it for the lag. So for example, what we have right here in the white line is we have the global liquidity adjusted for a 12-week lag. And then in the green line, we have Bitcoin. And what we can see is that they overlay almost exactly when you adjust it for the 3-month lag. And what we can see is that we've been in this bottoming zone right here, both in the Bitcoin price and the global liquidity, because, as I said, it was drained out last quarter. And now that global liquidity is taking off, we're seeing already the Bitcoin price is following it. So you can see this over and over and over through all of these charts. But the reason why we talk about what Scott Bessent is doing and Howard Lutnick is doing and Trump is doing is because they're trying to do something monumental. They're trying to change the entire global monetary system. And they're using tariffs to do this and using trade negotiations to do this. But there's a couple things that I want to draw your attention to. Mainly, read and listen. Why? Because typically we've had, politicians and Fed board governors, they try to sort of hide what they're doing. They try to mislead us so we don't front run the markets, we don't front run them. But the Trump administration has done something much differently. They're laying it all out there for you. And if you read and listen to it, you'll hear exactly what they're having to say. Trump's head of his economic advisory board, Hudson Bay Capital, wrote this executive summary in November of 2024 when Trump was running for president, when he was winning the presidential cycle before he was there. And this report, you can find it online, it lays out exactly what Trump is doing to a T. Bessent is talking about it. Now, what we can hear now is that, well, if you read the report, the goal was to push the tariffs and then bring them back. Use the tariffs for negotiations and bring them back. And already this is exactly what we're seeing. All over the news headlines are, Trump's caving, he's always going to cave. Yeah, that was always the plan. If you read The Art of the Deal, you anchor high, you negotiate off of this. It was in the report right here. In this video last night, Scott Bessent was saying, hey, we have these deals. They're coming together. We've got the negotiations. Here we have a tweet that I put up the other day. And I said, India, tell me there's a trade deal coming without telling me there's a trade deal coming. Because we have the president of India over here in the United States. We got J.D. Vance over there visiting him. All this favorable talk. Like the deals are coming. And while everybody's focused on that, on 2D chess, the undercurrent is the global liquidity that's really driving things. And regardless of what happens here, we know more liquidity is rushing into the system. That's why I've been talking about it over and over and over for the last 2 years now or so. If we keep our eyes focused on that and sort of start to ignore the noise, we can see what liquidity is doing and we have time. We have a 3-month lag to get in position or out of position. Now you're out of time because now the tide's already rushing back in. Bitcoin's already up over $10,000. If you miss those $10,000 days, you miss most of your gains. So we want to get in a position before the tide runs, not after.
April 2025 marked a pivotal moment where financial markets, geopolitical maneuvers, and digital assets intersected with dramatic consequences. U.S. President Donald Trump's aggressive tariff policies targeting 185 nations sent shockwaves across global markets, wiping out $8.5 trillion in equity value within days. The S&P 500 suffered its steepest decline since March 2020, plummeting nearly 6%, while the Dow Jones Industrial Average collapsed by 2,200 points. Yet amid this turmoil, Bitcoin staged an impressive recovery, rallying 16% by month's end. Simultaneously, Ethereum strengthened its position as the leading platform for real-world asset tokenization, now commanding 60% of that burgeoning market as institutional heavyweights like BlackRock increasingly embraced blockchain infrastructure. This divergence between traditional financial markets and cryptocurrencies isn't accidental, but reflects deeper liquidity dynamics. Financial analyst Mark Moss has consistently emphasized that asset prices respond not to headlines but to liquidity flows, typically following a 10 to 12-week lag pattern. The current $5 trillion liquidity surge refilling the financial system, following the drain in late 2024, represents the invisible force powering crypto's resurgence. This analysis explores April's market convulsions, the political currents shaping them, and why astute investors are looking beyond surface noise to track the underlying liquidity movements. The implementation of Trump's discounted reciprocal tariffs on April 2nd created immediate market upheaval. Equity markets bore the brunt, with the S&P 500 plunging 12% by April 8th. Cryptocurrencies initially followed suit, with Bitcoin dropping 9%. But then demonstrated remarkable resilience, rebounding to finish April with 16% gains at $94,729. This stark contrast between asset classes reveals critical insights about market mechanics. The delayed effect of liquidity injections means the first quarter's $5 trillion liquidity increase is only now manifesting in prices, with scarce assets like Bitcoin and gold showing particular sensitivity as liquidity absorbers. Ethereum's growing dominance in real-world asset tokenization, evidenced by its 20% monthly growth reaching $6.2 billion, underscores its accelerating institutional adoption. This trend aligns with broader recognition of blockchain's potential to transform financial infrastructure, as even traditional finance leaders acknowledge Ethereum's natural advantages for tokenization applications. Political developments further complicated the April landscape. Canada's federal election resulted in a minority government for Prime Minister Mark Carney's Liberal Party, disappointing cryptocurrency advocates who had hoped for more favorable policies under the opposition Conservatives. Carney's historical skepticism toward cryptocurrencies suggests potential regulatory challenges ahead, though his openness to central bank digital currencies indicates a nuanced approach to blockchain technology. Meanwhile, U.S. states advance progressive cryptocurrency policies despite federal turmoil. Texas initiated a blockchain pilot program aimed at improving government transparency. Georgia moved to incorporate blockchain education in K-12 curricula, and Arizona enacted protections for home cryptocurrency mining operations. These decentralized policy developments demonstrate how blockchain innovation continues advancing regardless of federal-level uncertainties. The stablecoin market expanded by $4 billion during April, reflecting both regulatory progress and their growing role as digital safe havens. The advancement of the U.S. Stable Act through committee and the SEC's decision to drop its investigation into PayPal's stablecoin signaled improving regulatory clarity. Market analysts observed increasing reliance on stablecoins during periods of heightened volatility, further cementing their position as bridges between traditional and crypto finance. At the macroeconomic level, the liquidity supercycle tells a compelling story. After bottoming at $171 trillion in late 2024, global liquidity reversed course, reaching $176 trillion by April 2025, according to cross-border capital data. This resurgence explains the delayed positive impact now visible in Bitcoin's rally and gold's appreciation, both typically lagging liquidity movements by approximately 3 months. The Trump administration's economic strategy appears increasingly deliberate, using tariffs as leverage to redirect global capital flows before potentially negotiating partial rollbacks. This approach, hinted at in pre-election policy documents, suggests a calculated effort to reshape monetary dynamics rather than random protectionism. April's market behavior reinforced several crucial insights for investors. First, liquidity fundamentals ultimately override political noise in determining asset performance. Second, scarcity-driven assets like Bitcoin and gold continue demonstrating their value as liquidity absorbers during turbulent periods. Third, blockchain's real-world utility keeps expanding across multiple sectors regardless of macroeconomic conditions. For market participants, the lesson remains clear. Understanding and tracking liquidity movements provides more reliable guidance than reacting to surface-level volatility. As the $5 trillion liquidity wave continues working through global markets, the coming months will likely reveal further divergence between assets attuned to these flows and those still mired in traditional paradigms. In an era of economic transformation, Recognizing these underlying dynamics separates strategic investors from those left, wondering how they missed the next major market shift. As we wrap up, did you catch Bitcoin's 16% rebound last month? Or were you caught off guard by the liquidity shift? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.